Welcome to the weekly update. This is Being Prepared Saturday, April 2nd, where we'll go over the past action in the market, and then we'll look at the week ahead for April 4th through April 8th. So let's go back and look through the week session. We had some pretty solid gains to start out the week. Monday, we had an up day. Tuesday was kind of the power day as far as taking prices higher. And that's probably about when a lot of people started to understand that maybe this climb up out of that base is for real. Because you go back a few weeks and everybody was so negative. Everybody was so sure we're going lower. That's all you heard about, all you read about, all you saw. Well, when you get to that point, when everybody is feeling the same way, the stock market has a real interesting way of making the opposite happen. Well, that's what happened. Well, over this past week, we saw a lot of disbelief as the market was going higher and higher and higher. It can't go any higher. It can't go any higher. This is just a dead cat bounce. We can't go any higher. Well, on Tuesday, we saw some real technical improvement. We had broke through resistance. Some major indexes had been able to get above their 200-day moving average. And for a lot of people, that's the line in the sand. And when that happened, they were looking to go long. Well, wouldn't you know, that's just about when things stalled out. And we ended up giving back a lot of the gains and having more sideways to even negative move as Wednesday, Thursday, and Friday came around. And I have a chart that I'll show you here in just a second. So we still continue to be range bound in that we have that base that we came up out of where it looked like the end of the world was coming. And then we have the all-time high. And then there are some other ranges within those two areas that the market is still dealing with. For the week, it was kind of a treadmill week. We ran a lot, but didn't really go anywhere. By the time the week was over, we were only up 0.1% for the week. And it's kind of interesting in that volume was just about average. We're seeing a real drop off in volume these days, where there are days when we have higher volume, but then it tends to be average volume. But then we've even seen over the course of the time when we were climbing up out of that base, where volume was decreasing day after day after day. And it's a little hard to quantify things because some of those were down days, some of them were up days. You could take a little bigger picture look and go, yeah, people weren't really believing this, because when you see prices climb on declining volume overall, you're a little bit suspicious. And then, of course, the inverse of that is also true when we're going down on low volume. That's usually seen as a positive sign. The technicals on the weekly charts are improving. And again, some of these tend to really lag. I had a lot of people ask me about, what do you think of the oscillators on the weekly charts? And I tend to really be skeptical, mainly because these are longer charts and they can take some time to show any movement. And because of the way they're calculated, we're not necessarily getting a true picture of what's happening. I do like the oscillators on the daily charts, and I use those very heavily. But on the weekly charts, I need other evidence to support. I'll look at them, but I use other indicators as well to kind of reach some conclusions. We're still battling through earnings kind of on a case-by-case basis. The big topic these days it happens to be inflation. And then what goes hand in hand with inflation are interest rates. And we're in a rising interest rate environment now. We're seeing that in the bond market. We're seeing that in corporate bonds. We're seeing that in a lot of different markets. And most of all, we're seeing that in the Fed, where a lot of their statements have been made that, yeah, at the next meeting, we're probably going to raise rates. And it might even be higher than what we thought before. That's kind of the going scenario right now. Yeah, that can always change. There is also a lot of geopolitical concerns. We have the whole Russia-Ukraine situation. There are some lockdowns going on in China right now. Not necessarily that will impact the stock market directly, but it's part of this whole supply chain scenario. If China's economy really slows down, well, where does America buy a lot of things from? China. And we're already having supply issues. And is that going to even be worse? because of these lockdowns. And then we're seeing oil going all over the place. And there's a real debate going on. And as you probably are very well aware, oil is really going up. You're seeing your gas prices going up. Well, there were a couple of potentially positive things, at least that the market might take as positive, where the administration is open to the idea and is probably going to implement, where they start to release about 1 million barrels a month from the reserves. Now, some people think, okay, that's good, but that's not really going to change anything. Prices might drop a couple of cents. Then on the other hand, do we really need to tap into our oil reserves? Those are for emergency bases only. It's if we're in a war and somebody bombs one of our storage units that has all of our oil in it and we lose all that oil that we had. That's what it was created to do. Should we be tapping that at a time right now, especially with the geopolitical events? What if we run through a lot of those reserves and then need that oil for military purposes? So that's one side of the debate. The other side says, hey, that oil's sitting there and we were able to get it for a lot lower price than what oil is going right now. Maybe that will help people. Then on the other hand, you have people saying, well, okay, we might have got that at lower prices during the previous administration. Now, what are we going to have to pay to replenish that in the future? So there's a lot of this going back and forth. But the bottom line is everybody's paying more at the pump. It's what people really feel. It's the big topic right now. And so it's getting a lot of headline press these days. As far as our trend, we do show a weakening trend, and it is still negative, but it could be improving. And I'll go through and show the chart there. Here's the intraday chart. Every one of these bars is 10 minutes. Going back, here is Monday's session. I go back to the previous Friday, but I really only start looking at things in this video right here on Monday. We started out pretty good, and then things dropped off, but we had a really good climb into the close. Then the next day, this was when the big up move happened. That was on Tuesday. And even though we gapped a lot higher, we treaded sideways quite a bit, but then we saw some late day buying, and that was seen as pretty positive. Then we hit Wednesday, we gapped lower and dropped off. Then we had Thursday, we gapped a little bit lower there and then really dropped off. There was a lot of really late day selling, because this was the last day of the month and the last day of the quarter, and there was probably some shoring up, some adjusting going on. Well, Friday, we had an up day, but the damage had already really been done. We dropped down a couple of times during Friday's session. We got down here to R1. We were able to bounce up off of that, and then we saw some late day selling. And then right at the end, we saw some real buying coming in. And that's kind of what saved the day on a closing basis. Because if we had closed down here, that would have been a negative day. Since we had this big spike up right at the end, that turned it into a positive day. And I have to clear my throat. And I'm still dealing with a lot of congestion. So the different indexes, the Dow was down 0.1%. NASDAQ was up 0.7%. Here's the S&P up 0.1%. And the Russell, which is this, I look at the small cap index. This is also a small cap index. It did a little bit better, up 0.6%. So not a real big move when everything was said and done. Here's what the sectors did over the, the indexes did over the last week, or the small caps. And these numbers will be a little bit different because I just go the trading days that actually occurred, where some people go back to the previous Friday to do the calculation, where the small caps actually performed about the best. Right here, this pink area, this is the S&P. It was down slightly according to this measure. And then the NASDAQ 100 actually kind of, but none of them were either up or down more than 1% on the week. So it was kind of a treadmill week. As far as our sectors, then this goes back through the previous trading days, where real estate, which had just been getting hammered pretty good, it was up over 4.5%. And utilities, which have been doing quite well. Then we have staples. Those are the things that you have to have. It was up over 2%. And we're kind of getting down into the middle area here. There were 4 areas that were actually down: materials, industrials, those are more value plays. Of course, energy was down a little bit on the week, and financial sector. The banks are taking a little bit of a hit right now. Here's what it looks like in just the performance throughout the week, with real estate doing the best and financials doing the worst, and then all of the different sectors in between. Then looking at a site called currentmarketvaluation.com. This, I have nothing to do with this site. It's free. I just go to it and I look at their charts. I've published a number of videos about this and how we can use these tools to our benefit. But this is just a screenshot of all the different aspects that make up their valuation model. And then they kind of cram them all together and they say, okay, based on these 6 models, we are fairly valued, or we're overvalued, or we're undervalued. And that's okay. That's good to get a nice big definition, but it's still good to look inside. And what's kind of neat about their website is, if you look at this chart, this is a live chart. So we see this is the yield curve as of March 31st, and they are considering this fairly valued. Now they look at the 10 to the 3 month yield curve. And if that's another thing that's really been in the news a lot lately, that curve is actually going up, where if you look at other yield curves, they're going down. And please watch some of my other videos. And I did a yield curve video this past week that you might find interesting. But this just says that we're fairly valued. There's a thing called the Buffett indicator, where this takes more stocks and their relation to GDP. Well, we had been extremely overvalued. Well, we're back down to just being overvalued now. The PE ratio had been extreme. It's coming back down. Interest rates, which still are historically low, they're saying that these are fairly valued. Margin debt, which is one of the newer aspects that they've added to this model, it's really been dropping off lately, but we haven't had this updated now in a month. And then mean reversion. The mean is what should the S&P, what should its real price be? If you take out all the choppiness and you look not necessarily at an average, but the mean of the S&P, and then where are current prices in relation to that mean? Well, we had become extremely overvalued, where we're coming back down to an overvalued situation. So when you take all of these together, I don't have it on here, but if you go to their website, they'll say that we are fairly valued, not too hot, not too cold. Now, you may agree or disagree with that. There are other measurement tools that we should use in addition to this, but this can be just one of the overall pieces of the puzzle. As far as sentiment this past week, after coming off being really pessimistic, the American Association of Individual Investors, it's more into a neutral reading right now. And then this is the ratio between the bearish funds and the bullish funds, the RIDEX funds, where, and it looks a little more pronounced if I have a shorter term chart, but we had spiked up, meaning that there was a lot of fear in the market. Well, a lot of that fear has worn off with the advance that we've seen, and we're now back down to more of a neutral reading. Then the VIX, which also measures fear, it is actually declining on a closing basis, and we're coming down below 20. And generally between 12.5, 12 or so, and 20, that's more of the normal area. And when we start to get above 20, that's showing extreme fear. When we really get down to 14, 13, 12, and even below that, that means there's extreme complacency in the market. Then down below, we have a bar chart just showing how things perform for the week. So overall, the VIX did decline. And then the Ulcer Index, as this is going up, that means people are freaking out. Fear, panic, pandemonium. Well, we advance slightly. On the daily chart, we're going down, 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 down. Well, in the weekly chart, we're still going up slightly, but could be starting to roll over. So there's still some pretty good fear in the market right now, according to that indicator. Another thing that we can look at, It's called the Chicago Fed National Financial Conditions Index. Yeah, love these long names. And even the acronym, NFC. You come up with your own saying if you want to. But basically, what this is, this just measures how's the economy doing. When we're above this black line, that means people are freaking out and they're not really optimistic about the economy. And you can see back in the past, we had a little spike during the COVID plunge. We had a spike during the whole financial meltdown. And then the 80s, which were all crazy, only to be preceded by the 70s, which are even crazier. This just shows when we're above this line, things are not looking very good. When we're below this line, things are okay. Well, look at where we're at right now. We are going up, but it's not really in freak out mode right now. Then another one is just the spreads between the risky spreads and the not so risky spreads. When this really starts to spike up, that means the default levels are pretty high. You can see back right after the dot-com boom and bust, it went up a bit. Where it really went up was during the financial meltdown. And sorry, I try not to get this stuff when I do a screenshot, but it ended up on there. Then when we had the COVID plunge, things started to spike up. Well, what's happening right now? We're actually going down. So there's not a lot of fear on an economic basis, according to this chart. So things still seem to be okay. I know you hear a lot of different things in the news, and we've got inverted yield curve, and everybody's got a prediction that we're going to be in a recession and the economy is just going to blow up. That may eventually happen. We just look at what we see right now, and it's not telling us the same thing. There are some charts that do tell us that, but we also have other charts that are not saying that. Another thing that came out this past week is the National Association of Active Managers. I think that this NAAIM. These are actively managed mutual funds or hedge funds where the manager goes in and tries to get the good investments, or if one's failing, they'll switch out of one area and get into another area. Unlike a passive mutual fund, which is just based on an index. Well, when this is declining, that means that they're getting out of fear type investments, mainly meaning stocks, and they're going more towards value or risk off type of investments. Well, we really had a decline few weeks back. Since the bounce, we are seeing this really come back up, and we're more in the neutral category. We really start to take notice of this when it gets above 100. It just shows that there's probably too much optimism. And then here it dropped below 40, but at the same time, we might even pay attention to it anytime it gets down below 60. This only comes out once a week. It's a little bit delayed data. Can't really make decisions based on this. It just gives us some idea of where things are at right now. As far as the Fed, I'm not really covering this in the daily videos right now, just because this changes a lot and there's so much time and so many variables that play into this. But as of Friday, there is a 69.4% chance that at the May 4th meeting, when the Fed gets together, that they will end up, after that meeting is finished, that our interest rates will be at 0.75% to a full percent. That's 50 basis points above where we're at right now. And that's kind of the conventional wisdom at this point, is they're going to do a 50 basis point move. Now, what we need to do is look at all of the economic reports and watch the bond market and watch, of course, the stock market, and how is everybody reacting to that? Because this is the working scenario right now, but we've got more than a month until that meeting, and lots of things could happen. So, and this changes on a daily basis. Then we also have a historical chart just to show you how these different rates have gone up and down in probability. Then looking out for the June meeting, right now, they think that after that meeting, it'll be the prevailing stance is that there's a 63.9% chance that we'll be at 1.25 to 1.5 after that meeting. But again, these change all the time, and I don't have a chart for that. And then this is the Fed balance sheet, which, okay, they're raising interest rates on one hand, which is to slow inflation down. And then they're also adding to their balance sheet by quantitative easing. We haven't seen any real tapering back yet or even stopping. So as I keep saying, it's almost like the Fed has their foot on the gas and the brakes at the same time, because this is trying to stimulate inflation and stimulate the economy where interest rates are to slow things down. Then, as far as our breadth, we're still looking pretty positive overall. We're seeing an uptrend based on price. We dropped down below this moving average, but we bounced up ever so slightly in the past week. So we're seeing some improvement as far as advanced decline issues and advanced decline volume. The AD ratio, advanced decline ratio, it is above zero and advancing. So that is positive. Here we have the new highs and new lows. We saw an expansion of new highs, so the overall trend continues to advance. That's another healthy sign. And then here's the accumulation distribution. When this line is going higher, that means shares are being accumulated. When it goes down, that means they're being distributed or sold. Well, we're seeing this slightly above the moving average right now, even though it was pretty flat on the week. As far as our trend, we are still negative because the red line is on top. But look at the ADX, it's starting to roll over. So this could show a weakening trend. We're also seeing an increase in the green bar. If we can get these lines to cross, that would switch the ADX over into a positive trend. And then as these two lines get further and further apart, this line will continue to go up. As they get closer together, this line will turn down. And at least on a weekly basis, we might go into more of a range-bound environment. And another thing is the Arun. When the green is on the top, that means buyers are in control. When the red's on the top, that means sellers are in control. This is still negative. The daily chart looks more positive, but it takes some time for the weekly charts to adjust. It shows that the sellers are in control, but that's declining right now. But it's also showing a decrease in buying. Okay, because the green line is below the red line, that means we're below zero down here in the oscillator, and it was pretty much flat over the past week, but we're still negative overall. Then we're looking at the mass index here, where it climbed above 27, and we're still now waiting for it to come back down to 26.5, but that has not happened yet. Some of our long-term charts, here are the pivot points where we are above the pivot. That is positive. And here's the resistance levels above and the support levels below. Looking down at volume, we see that we just about got to this moving average of volume. And looking at the S&P with a 50-period moving average, we are above that moving average right now. So that is positive. Then another set of moving averages where we have a 13 and a 50. It's showing a potential death cross, but price right now anyway continues to be above both of the moving averages, which is more positive. Then the BPI, bullish percent index. This is showing some real strength. There's been a lot of BPI buy signals, and when we're going up, this has a tendency to advance. However, when we get above this blue line here, that means we're getting extreme positive. Now, I haven't turned back down necessarily yet, but that's just something to be aware of. Then we have another thing called the Chaikin oscillator. After giving a really extreme negative reading and then hitting an even lower low and then a higher low, it kind of went sideways, but still is showing that there is improvement. Then this is just a longer term look at the same indicator. Chaikin money flow continues to be negative and actually declined a little bit. This can be a weird indicator. It doesn't act the way you think it would sometimes. Then the force index, even though we came down slightly, we are green, so that is positive. The McClellan oscillator on a weekly chart, after getting extreme positive, we're coming back down. But we're still above zero, so that means this indicator is still positive. And then this is a summation index where we are advancing based on price and we're also advancing based on volume. So that's looking more healthy. Here's the oscillators that I talked about earlier, where here we're going up and up and up, and these things are really rolling over. Yeah, you could say, all right, we're going to have some kind of a mess here, which we have had. But really, in the scheme of things, from the all-time high in early January until the low that we hit, at least on the S&P, that it's not that big of a deal. I mean, people are calling it a market crash and everything. No, it was just a pullback. Now, other areas of the market, small caps, NASDAQ, they got hit a lot harder, but they're also starting to recover at the same time. Well, some of these oscillators are showing some improvement right here. And if you use these on a weekly basis, first of all, be careful, but they are starting to show some improvement if you feel that you can believe their calculations. Then here's the PMO, which is still declining. This is one that I actually have more interest in. This is based on price and based on volume, and it does show that we are improving. Then another PMO study, which I do like, this is the number of PMOs that are rising. On a weekly basis, we had gone extreme positive. Now we're falling back a bit. Well, we are extreme positive with those that are generating buy signals, but that is falling, but hasn't fallen below the green line yet. Those that are above zero continue to advance, and that is fairly healthy. Then the RSI continues to be above 50, even though it was a bit flat on the week, but that is more positive. Special K, when we're above this red line, that means that we are in an uptrend, even though we've been seeing this come down slightly since the beginning of the year. Here's another thing, this STO, short-term oscillator. We are positive based on price and volume, but we did decline over the past week. Williams percent R above 50, kind of plateaued out a little bit, but that would be more positive. Where here we have the Stochh RSI also above 0.5, which is almost like 50, even though it rolled over a bit or went sideways a bit, it still continues to be positive. And then the Vortex, we're seeing a decrease in selling and an increase in buying. They haven't crossed yet. That's when this indicator will actually turn positive. But that hasn't happened. Ultimate oscillator is above 50 and advancing. That's positive. Money flow index above 50 and advancing. That's positive. The percent B, this just measures the distance between the Bollinger Bands and then where is price within those bands. When we start hitting the upper bands, that means we're extreme positive. When we hit the low bands, that means we're getting to the point of being extreme negative. Well, we're just about in the middle right now. And then this is the Kopik curve. And this is really good at, sometimes it can be good at finding bottoms in the markets. You don't use this for tops, where when this really spikes down, then what happened after? We saw a nice up move. We spiked down here, then we saw a pretty solid up move. This is after the COVID plunge. We went upward. Well, this is starting to turn up. Now, you might be a little suspicious of this because we're turning up after not really getting very far negative. Okay, you can make a case for that. We just want to keep an eye on this, and it is picking up this bounce that we've been seeing over the last few weeks. Our different charts, the Heiken Ashi is looking a lot better than it was before. Our Kegi, the black means that we are positive here. Renko still hasn't really shifted over to more of a positive stance right now. It's still drawing in a solid red box, so that's negative. And our equivolume just shows that lots of nice green candles, which are more positive. Point and figure, we had some new X's drawn on the chart where it's the last signal that was generated on March 14th is saying that we could be experiencing a double top breakout. And to have those new, now this got picked up earlier in the week, and then the late week stuff didn't really get charted here. Because remember, this looks at price movement. It doesn't take into account for time. So it's just kind of right now thinking, well, we declined, but we've already been here before, so we're not going to put that in as part of the chart. Then our 3-line break, a little bit of a dark candle here, but it's still going up overall. Different trading systems. The Elder Impulse system is still positive on the weekly chart. And the SAR, stop and reversal, this is coming in with a dot right now, which could be positive overall, but we're still coming out of a negative environment. And then you'll notice on some of these charts, you'll see April 1st. I just didn't have time on the 31st. That was a Thursday, and I'm doing all kinds of other videos at that time. So I wanted to wait until the weekend. So some of these charts might not be exactly end of month. Then looking at the S&P, showing on a weekly basis how we've been bouncing back up. Mid caps trying to get back up there, but still more sideways overall, as are the small caps. Lots of sideways motion right now. Looking at our all stocks, we had some real weakness here. We've been able to come back up and get above the 13-period moving average, but we still have a recent death cross in our rear view mirror here. We want to see this get above the moving average for a lengthy period of time and have this actually turn into a golden cross instead. If you're positive on things, then here are mid caps showing a lot of sideways movement, a recent death cross, but we're right in between those two moving averages right now. Small caps, kind of the same story. Recent death cross, right in between the two moving averages with a lot of sideways movement. The Dow, that was one of the big things. The Dow was able to close above its 200-day moving average. Well, then a lot of people decided it's time to get in. Well, that's when we dropped below the 200-day moving average. It's also coming off a recent death cross, but we're right in between the moving averages. NASDAQ, kind of same story. We hit right up to this 50-period moving average, which may be acting as resistance, and we're right in between the two moving averages right now. NASDAQ 100, also, we poked our heads out a little bit during the week, but we closed inside the distance between these two moving averages. And here's the NYSE, big broad base. We are coming off of a death cross signal here. So this might concern a lot of you that use moving averages to make your determinations. Then the Wilshire also had a recent death cross, but price has been bouncing back up. FANG stocks, recent death cross, saw a bounce, but still has a lot more to go if we're going to see follow through improvement. Here's ARK, where it was up on the week, but it's in an overall downtrend, and it has a lot of damage to repair if you're a Cathie Woods fan. Then the big software companies, this just shows that we've been setting up some kind of a base. We have a 50-period moving average, which is going down, and price is below that moving average. So this, yeah, it could be building a base right here, but it still hasn't really turned positive on the weekly chart. Looking at some other markets, here is the CRB index. This is my main gauge for inflation, where we've been in a really powerful uptrend. Well, we fell back a little bit, but that overall uptrend is still very much intact. Then looking at gold, which looked like it was breaking out, now has been, at least to this point, looking more like a fake out. Same thing with silver, looked like it was breaking out and then fell back down. Oil, which had screamed all the way up to 130 a few weeks ago. Now, it actually closed at about 100. This is Friday's close for April 1st, where we actually went down below 100. Then here's the dollar, which has really been doing quite well. This is the weekly chart showing an overall uptrend right now. Some of our relative studies, if you compare bonds with stocks, well, this is how you would have performed. This means bonds were the not so good place to be, and they still continue to be the not so good place to be because stocks really outperformed bonds. Then this is a longer term chart. It's a monthly chart where we're taking a ratio of stocks to bonds. This just shows that if you had been in stocks for the last 10 years or so, you've been doing quite well. And we're also starting to see a follow through to this breakout to the upside. So there are some really positive things happening in the stock market. There's also some very negative things at the same time. And that's what the stock market likes. It likes to climb a wall of worry, or at some point, sentiment will, or something will happen and it will send prices lower because we're also overpriced at the same time. So that's part of the fascination of this whole thing. This is going back 1 year. It's a daily look at intermarket analysis, and it just shows a year ago from where we're at right now with oil. My gosh, 83%. Woohoo! And then how the S&P has been performing over the last year, how gold has been performing over the last year. This green line is the dollar, and then we have the price of bonds, not interest rates. These are the price for bonds. Then looking at gold against the dollar, it looked like we were trying to break out here, but we haven't even been able to come back up to these other trend lines here. Then gold against the S&P. It looked like gold was really starting to break out. Well, it's coming all the way back down, and it's down to the 13-period moving average right now. And then looking at these low volatility stocks, the stocks that either do well in down markets or do less bad in down markets. They were not the place to be over the last few years. As the market's going up and up and up and up and up, you wanted to be in the volatile stocks. Well, as things shift, we're seeing a real change into the low volatility stocks actually holding up. And in this case, in the past week, they were up almost 2.25%. Then looking at the growth versus value battle that keeps going on, this is how growth outperformed value over the last few years. Well, since the beginning of the year, value has been outperforming. So we're seeing growth really decline, even though it bounced back slightly in the past week. Then this is the NASDAQ 100 against the S&P 500, the big monster stocks in the NASDAQ. It advanced slightly, but we're well below a declining moving average. Then the S&P 100, those stocks that are the biggest part of the S&P 500, they underperformed the S&P 500 just a little bit. Then comparing discretionary with staples. Discretionary, the things that are nice to have, the things that make life worth living, it seems. And then the staples, the things, the toothpaste, the toilet paper, the things you have to have no matter what's going on in the economy. Well, we measure the ratio between the two. In a good, solid, healthy environment where people have more money to spend and are out having more fun, this line will go up. Well, since the beginning of the year, we've seen this really decline overall. So what is our outlook then for the next week? I would submit here that even though there are lots of things to be concerned about, the long term does look to be improving. A lot of our charts are still looking okay. There's a lot of negative backdrop out there. There are things that can really influence the market. But looking at our charts, and that's what ultimately we have to come down to, is what do you see? Not what are you hearing, not how you feel, but what do you see right in front of you? And it does look like things are getting better. There's always going to be points of concern. There's always going to be positive and negative sides to things. It's just how objective do you want to be about it? My personal conclusion is that the long-term trend is improving. There are going to be some major economic reports released in the coming week. On Tuesday, we have the ISM non-manufacturing index. We had the manufacturing index released this past week. Well, we have the non-manufacturing index coming out. And then Wednesday, kind of the other big thing is the meeting minutes from the FOMC, what everybody said and how they voted and their opinions. That's going to come out on Wednesday. And that can be a big deal, especially in a rising interest rate environment where we really want to know what were these people saying? What are they thinking? Do we need to freak out and fear what they might do in the future? And then the continuation of the different geopolitical events, Russia, Ukraine, and that can go back and forth based on rumors, based on facts. It's really hard to get really good, solid information about that. It's just a heavily emotional situation right now. We're still dealing with the lockdowns in China. We have all these yield curve issues. And please go in and look at some of my daily videos. And then I have a separate yield curve video that I posted. And then the oil situation that I talked about more at the beginning of the video. So here are the different scenarios that I'm currently working through. And I usually try to have three scenarios at the same time. What's going to happen if we go down? What's going to happen to make things go up? What's going to go down to make us go sideways? Okay. So what are the things looking at that we could focus on that the market will go down in the coming week? Well, we hit some short-term overbought levels and resistance, and the market's getting a little bit tired. Well, it actually declined a little bit more, and we're actually showing some more short-term potential weakness. So we're asking a question: are the recent declines a reversal? Are we going to get set to go lower from here? That's one possibility. Or are we just going to wear off the short-term overbought condition before we get set to go higher? And we're watching that all the time to see what scenario seems to be most likely. We're also in a rising interest rate environment. If interest rates really start to shoot through the roof, that can come over and have an impact on stocks, usually by selling. And then these different yield curve concerns that people are all freaked out about now. Some yield curves are inverted. Some are actually going in opposite directions. And so there's a pretty hefty debate going back and forth. Also, a big reason why we saw that bounce, because everybody was so sure we're just heading lower. Well, we didn't. We ended up going higher. And it's like, okay, that's just a dead cat bounce. Well, another update. Well, it's just another, got two dead cat bounces now. And 3, 4, 5. Oh my gosh, we're back up to the 200-day moving average. I better get into the market. You were reacting at that point, and just about at the point where some people started to believe that this was for real, that's when we stalled out, at least as of right now. And then will the sentiment turn more negative? Right now, we're right down the middle. We're not, we're at, I think, 51 or 49. We're right on the line between being extremely negative or extremely positive. We're nowhere right now. We could go either way very easily. Okay, those are the down scenarios. What's going to keep the market going up from here? We are seeing that strength after building a base. Our oscillators on the daily charts mostly continue to be positive, and we're seeing a lot of improvement with our oscillators, even in the weekly charts, even though I don't use them all that much. But on the daily charts, it's showing a little bit of weakness. Okay, so things are positive, but we need to see more buying coming in if this up scenario is going to maintain validity. Some of the moving averages are providing support as well as resistance. And then this whole disbelief versus belief idea. Then another thing that we need to watch out for is if the ADX, either on the daily chart or the weekly chart, continues to fall and goes below 20, that could mean that price movement is slowing down and we get more into a trendless environment. That could be possible, but with the real decline in volume, you're seeing a real lack of conviction, and people just don't know what to do. There's so many variables out there, some positive, some negative. Any one of them are market moving. And so you have a lot of folks that just aren't real hot and heavy to be involved in the markets right now. So they're just sitting on the sidelines. Okay. Be aware that in addition to this video, I do have other videos. I do a daily snapshot video. Some of my videos can get kind of long. I try to make a short video, usually around 10 minutes, where I don't really go through many charts. I mainly just go through my slides that I have here and just hit the high points of the day. You can go through and watch that. And if you're at a point where you're making a decision, or if something that I talk about in the snapshot interests you, then you can go in and actually look at the full length daily video. That's just a resource that's available to you. Then we have the weekly video, which is what I'm doing right now. And then I'm gonna start posting a series of monthly videos. I'm already doing a monthly video on the markets, but my intentions are to do one on the economy, the different sectors that make up the S&P, and then looking at some international ETFs and indexes to see how are things going throughout the whole world right now. So thank you very much. I hope you have a good weekend and you have a great week. And if you don't watch any of my other videos, I will talk to you again next weekend.